So Warren Buffett seems to be making a bunch of moves here in the past few months, and we're going to go over and see what that looks like right now. And by the way, before you ask, Warren Buffett is still actually in charge until the end of 2025. I looked this up, so this is him apparently making these moves. So a couple of things that he's been doing. This came out just a couple days ago on the Motley Fool. Apparently, they sold shares of Bank of America in the first quarter and purchased shares of Domino's Pizza. So they seem to be selling Bank of America because of the looming threat of higher, or should I say lower interest rates, because it looks like the Fed could be cutting interest rates soon. They've hinted at that, even though they haven't done so up to this date this year. They've been kind of waiting and seeing. Domino's Pizza is the largest pizza company in the world. According to Motley Fool, they think it's expensive at the current price. We'll go over that here in a second. But the tickers here, you can get them confused. So make sure you look at BAC and DPZ when you do your research. Berkshire sold 48 million plus shares, cutting its position by 7% in Bank of America. And they bought 238,000 plus shares in Domino's Pizza, upping its stake by 10%. So they're not selling or buying all of either one of these, but making some sizable adjustments to their portfolio. Now, another thing that they are doing, according to AOL.com, is they pretty much sold their entire stake of two ETFs, which are pretty much the same thing. S&P 500 ETF, VOO, as well as SPY. So these both essentially have the same growth rates and everything because they both mirror the S&P 500. Obviously different price points. One is up 12.18% in the past year for VOO, and SPY is up 12.19% in the past year. So essentially about the same, of course, on both of them. So now let's look at Bank of America and Domino's Pizza, and let's see what Warren Buffett could be thinking about these and whether or not we actually agree. Bank of America, let's look at how they're doing. Actually, the funny thing is Bank of America is up 1.53% after he sold. Now, obviously, this is just from the news coming out that they sold. It's not necessarily like he did it today. So obviously, we don't want to get that confused. But year to date, in a pretty volatile year for the market in general, they're up 8.23%, up 21.96% in the past year, and up 105.46% in the past 5 years. And we are looking at a 14.2 PE ratio, which is pretty low, and a nice dividend yield of 2.19%. So both of those very attractive. Year over year change looks good for their financials all across the board. Cash and short-term investments down a little bit, but total assets, total liabilities are up. Now let's look at Domino's Pizza. So if you look at today, they are down 0.22%, not a real big change. Year to date, they are up 7.72%. They are up, or actually down 12.93% in the past year. And over the past 5 years, up only 23.62%. Now, if you're comparing that to, say, the S&P 500, you might have been better off just buying the S&P 500 all over that period of time. But of course, that doesn't mean that will play out the same way going into the future. PE ratio is 25.89 for Domino's Pizza, and they have a 1.54% dividend yield. So if you're comparing their PE ratio to what type of returns you might be getting, again, because a PE ratio is not always a one-size-fits-all, it also can depend on what industry the company is in. For instance, a lot of tech companies have really high PE ratios, but they get you much better returns. So dividend yield is decent, but you're looking really at better everything across the board for Bank of America. It's just a matter of how much will are we getting rate cuts by the Fed, and how much will that impact Bank of America as well as other bank stocks. Now, year over year change for their financials looks pretty good. Maybe it's one thing that Warren Buffett is looking at for Domino's Pizza. And then as far as some other indicators I like to look at, well, Bank of America, if you look at their PEG, so we've already been over their PE ratio, but if you look at their forecast 12-month forward PEG ratio, so you're combining that with projected growth and things like that versus PE ratio, you got a 1.27. So to put that in perspective, under 1 is typically undervalued, around 1 is fair value, greater than 1 is overvalued. So 1.27 is in that fair to maybe slightly overvalued area. Now, if you look at Domino's Pizza and compare them, they are, now again, this is a forecast, 12-month forward PEG ratio, but this is 2.58, which would be a lot more in the overvalued side of things, like significantly more than, say, Bank of America. So according to that, maybe a little overvalued. If you look at returns versus PE ratio, also looking a little overvalued. Financials might be pretty good, though, in the past year, which I believe Warren Buffett spends a lot of his time on, is looking at financials. Now, if you look at Bank of America, let's look at a few other indicators. Robinhood customers, if you care about that, I usually don't put much weight on that, but people are mostly selling Bank of America over the past month, probably because of the Fed talking about possibly having a rate cut. Now, hedge funds are selling more than they are buying on Bank of America, and then insiders, they were mostly selling quite a bit at kind of the second half of 2024. Right now, they're kind of split for the most part in the last couple of months. Now, as far as the consensus of analysts on Robinhood, you have 26 ratings with an 85% or so buy score, which is still pretty high, 15% or so hold score, and 0% sell score. And they're mostly hitting on their earnings as well. So now we look at Domino's Pizza. We have kind of a split between buying and selling, but it looks like a little bit more buying. Volume percentage increased by 55% versus the last trading day. This is, of course, only over the past month, possibly impacted by this news of what Warren Buffett is doing. As far as hedge funds go, more hedge funds are buying Domino's Pizza right now, which is interesting. Also, Domino's Pizza is probably seen as more of a safer kind of a consumer staple. So if there's a worse economy or interest rates go down, that kind of stuff may not impact Domino's too much. Maybe because of that, as well as the nice dividend that comes with it, could be a reason people are investing more in Domino's lately. As far as insiders go, now we do have mostly negative sentiment for Domino's according to what insiders are doing. So these are based on 2 informative transactions in the last 3 months. So not a huge sample size, but just maybe something to consider. Now, as far as analyst ratings, the consensus is not nearly as bullish from Robinhood analysts as it was for Bank of America. 57% give them a buy rating, which is just over half of them. 31% say hold, and 11% say to sell. And they do mention things like persistently higher inflation and hourly wages relative to food costs may favor grocery stores over restaurants, even though Domino's is seen as a cheap restaurant and, pizza chains in general. They're mostly hitting on their earnings estimates as well. I also like to look at how people rate the way the organization is run. Bank of America, banks in general, usually pretty good. Just under 4 out of 5 stars, 75% recommend working here to a friend, 85% approve of the CEO. Very good numbers. If you look at Domino's Pizza here, you have 3.5 out of 5 stars, slightly lower, not too bad. 59% would recommend working here to a friend. That's not really that great. As far as the CEO, not too bad on the CEO approval, 68%. Not too far off of the 75% or so I like to see. So it's kind of interesting to see, like, for instance, with Domino's, hedge funds. What do hedge funds know that we don't? Why are they buying more on Domino's versus many others? They're still considered to be overvalued. Returns have not been very good over 5 years, the past year, etc. that you've been, if you've had Domino's Pizza in your portfolio. PE ratio is not also that great. It's not that high necessarily, but it's also relative to what type of returns you might expect. It's not the best, but maybe their financials show something that is making hedge funds a little more bullish, or maybe some indicators in the economy as well. Although, as they said, inflation does hurt restaurants and usually favors grocery stores. Bank of America, though, their financials are good. Really, the only problem with Bank of America that seems to be kind of a looming issue is whether or not the Fed rates are going to be cut. We don't know for sure. It's kind of a maybe at this point. And how much is that going to impact the stock for Bank of America? So typically, if you look at how Fed rate cuts hurt banks or help banks, it has a mixed impact actually. So lower rates can stimulate borrowing and economic activity, but it also can compress their profits by reducing the interest margin between what banks earn on loans and what they pay on deposits. So it's really a matter of is this going to lead to more borrowing activity and economic activity? Is this going to stimulate the economy, or are you just going to see a reduction in profits for banks and not enough activity to make up for it? That's really the question here with Bank of America. Personally, I would want to wait and see what the Fed does. I don't actually have stock in Bank of America right now. I don't think I would buy any right now. And if I already had some, I would probably just hold it. Honestly, most of their numbers look really good. It could be a nice stabilizer if you have a lot of tech stocks to have some other ones like banks. And I don't know if I would put them in sell territory yet. Now for Domino's, I would not buy Domino's, even though some of these other ones are. It's just not really what I look for. I really just don't believe they're going to give me the type of returns I want. My entire goal is to beat the S&P 500, not to just get a 1 or 1.5% dividend yield and buy something that's really conservative that's probably not going to make major changes anytime in the future. It's just pizza. What else are they going to do? I just don't think the dividend yield for what you're getting is high enough for what they are going to probably return, even if the economy gets a little bit better. Again, there are some indicators here that they are actually still overvalued.